Good afternoon. Thank you to our audience, and we look forward to making this presentation today because we are experiencing an event unlike anything that we've seen, at least in my lifetime. And the jury is out still as to the ultimate economic impact or end to the virus spread. But while things may seem scary, and believe me, we are truly empathetic that can feel like a scary time. The goal of this call is to give you relevant, timely information and confidence that we are monitoring the situation daily, and our investment committee is making appropriate changes to the portfolios. Our investment committee has been going through significant modeling, which Aaron Tuttle, our Chief Investment Officer, will be going over with you. But I just want to assure you that we are very aware of how emotional these times can be. But we are on top of things. And so, Aaron?
So this will be a very technical update, and just like the previous one, probably more so than the previous one. We will do our best to be clear, but we think it is beneficial for our clients to understand how we are assessing the current market environment. This will require a review of Morningstar's macroeconomic model that we are using to understand the expected impact the coronavirus may have on the economy. We will review some terms that many of our listeners are likely very familiar with, as this has dominated the news. We will review 3 scenarios in the macro model: the bear case, the base case, and the bull case, and the economic impact expected based on supply side factors and demand side factors. We will discuss the possibility of a recession, as well as current monetary and fiscal policies making their way through the system. But before we get into the model, let's do a quick review of terms to help understand the factors in the macro model, though many are likely to be familiar at this point. Transmission, or the reproductive rate, RO. This measures the infection growth rate of the number of new cases. It is instructive because we can monitor the exponential growth of the virus. What we are looking for is the change in the growth rate of new cases. If you divide yesterday's new cases by today's new cases, you can measure the transmission growth rate. A growth rate of 2, as an example, means that for every 1 person infected today, 2 more cases will show up tomorrow. That is how we see such exponential growth. When the number is 1 or less, we hit what is known as the inflection point, and the growth rate begins to slow. And when we hit this inflection point, we start to see, or what we're hearing about, the curve is flattening, meaning that growth case in new cases is slowing. Now, this has happened in China and South Korea and is now approaching in Italy. What we don't know is if there will be a second wave. Let's move to fatality or mortality rate. The macro model is using the mortality rate. This is different than the case fatality rate, or CFR, that we often hear in the news. The CFR measures the deaths per known cases. This biases the number of fatality rates higher, since testing is likely only in those in serious or critical condition. It is missing the healthier population that is also infected. The fatality rate instead is the measure of the deaths per the overall population, a more known number. There is usually a high to low relationship between these 2 factors. Common colds have a high transmission rate but low fatality rate. Oftentimes people have colds 2 to 3, maybe 4 times a year. It's not a big deal, it's just uncomfortable. The Ebola or rabies have very high fatality rates but low transmission rates. It's not easy to be infected. However, and this is where it gets scary, and oftentimes what we see in movies is when they are both. The smallpox and the Spanish flu are examples of both high transmission and high fatality rates. One thing to consider is fatality rates tend to drop over time, but not always. The swine flu, which was in the headlines in 2009, started strong with fatality rates of 10 to 20%, but quickly faded well below the seasonal flu rate of 0.1%. Now, why does this happen? No one really knows, but the speculation is that strong viruses have lower transmission rates because they kill the host quicker and reduce the number of particles that are shed. So if you die in the first day or the second day, you only have 2 days of shedding particles, where some of the lower or weaker strains, if you live 7 days or you make it through the whole time, there would be far more particles shed. So the growth rate of the weaker virus strain would actually grow at a faster pace. Another reason that it slows is medical intervention becomes more effective with more experience. Doctors just begin to learn better treatments, and we're already seeing that in place. A lot of the medicines, whether it's Ebola or autoimmune, have had some success. Now, I did say or mention, but not always. Spanish flu did not drop, but came very strong in the second wave. So it's not to say that this has to happen. So what do we see in the coronavirus fatality rate? There's still a lot of noise in the data. The two extremes, though, are South Korea and Italy. South Korea has a much younger population, as well as the infections were weighted towards the 20 to 29 age bracket. Why is this? Because the virus came in through a church, and the church is a younger church. So most of the people in the data from South Korea are already younger. They also did a lot more tests. So more healthy people are included in their cases. So the case fatality rate was 0.6% in South Korea. Italy, which is an older population, and we don't know exactly why, but the infections mainly hit the older population. They also have not done near the amount of tests that South Korea has, saving their tests for mainly the people that are in critical to serious condition. So the CFR there is at a much higher rate of 7%. Now, these are on the extreme. What's probably a more likely or a better sample is the Diamond Princess with a 1% CFR. And this is in line with the CDC's estimate of below 1% after they initially ranged a 12% fatality rate. Also, seasonality plays a factor. The coronavirus is a type of virus. This is not the first time the coronavirus has arrived. This is just a mutation of a virus in the coronavirus family. This type of virus usually slows in March to April in the Northern Hemisphere. Data suggests that this is likely to be the case because most of the epidemics are in the Northern Hemisphere. That does not mean it's definite. There's other data that is challenging this, and we just don't know for sure. But it also means that it could move to the Southern Hemisphere and come back in the fall or a second wave. Again, many are likely aware of this information, but these are all factors considered in our macro model. Let's review the 3 scenarios in the model. The bear case scenario. The probability of this occurring is given a 15% weighting. It assumes 30% of the global population is infected and a 0.8% mortality rate, or 0.8% of the world population. 18 million deaths globally and 700,000 in the US. I want to repeat, this is the bear case scenario. This assumes extended school and office closures, potentially for 6 months, and a significant impact on the retail and service industries, with high pressure on families as they care for children and sick family members. Travel, Tourism and hospitality contribute approximately 7.6% to the US GDP. This is a very large number, but that also means that there's over 90% other industries that are not as visible as these parts of the economy. The economy still has economic activity. So the bear case scenario would have a 5% decrease in the gross domestic product. This would be similar to the 1918 Spanish flu. As a comparison, the 2008 crisis has been estimated that the GDP dropped 8.3%. Let's go to the base case. The probability of this occurring is 60%, and it's the most likely in the macro model. This would mean 20% of the population is infected, or 1.5 billion people globally. This is 2 times higher than the flu, which ranges from 3 to 11%. So it's 2 times higher than the high side of the flu. With a 0.5% global fatality rate, that would equate to 8 million deaths globally and 200,000 in the US. The flu, in comparison, kills 12,000 to 61,000 annually for comparison. Now, there is a slightly lower fatality rate in the US of 0.3%. The reason is the US has more ICU beds and ventilators than other countries. Now, this still assumes that hospitals are stretched, meaning there's not enough to meet the demand. But the US should do better than other countries, and this is reflected in the model. The model does consider enforced social distancing policies that we are already experiencing. We expect newer cases to be easier to diagnose and treat. We're seeing a jump in the ability to test and some promising pharmaceuticals already in the chain. It also includes the potential for a second wave in February, since it is unlikely herd immunity is achieved in this scenario, meaning not enough of the population has actually been exposed to prevent that second wave. The potential impact to GDP would be a decrease of 1.5% from the current level. Let's move to the bull case scenario. The probability of this occurring in a model at this time is 25%. So this is more likely to happen than the bear case in the model. 10% infected, or 770 million people globally. This would be the high end of a seasonal flu. So a very infectious flu virus usually infects this many people. We're also assuming that it drops to the flu fatality rate of 0.1%. There would be 800,000 deaths globally and 30,000 in the US. It also assumes that COVID-19 does not return in the fall. The potential impact, it would be limiting the impact to the first quarter of 2020, China being hit the hardest. Now, when analyzing the political economic impact of these scenarios, we look at 2 components: the supply side factors and the demand side factors, supply and demand. On the supply side, labor supply would be curtailed due to death, illness, quarantine, and preventative furloughs, whether government enforced or elective. Businesses would close their doors, and tourism and transportation, retail and restaurants would be hit the hardest, as well as significant supply chain impacts, such as iPhones and cars, which would be delayed as they waited for parts in the manufacturing process. Let's move to the demand side. Confidence is its key driver, and confidence is a very elusive concept to quantify, but we know it will drop, and especially for consumer confidence. We will also see a reduction in business investment. There will be laid off workers who are trying to conserve cash. While these are serious potential drivers in the short run, they should abate. Workers will return and be ready to spend. Confinement has a significant effect on the psyche. As an example, a woman fell 10 floors in China trying to get out of her quarantine building. Now, this is certainly not the norm, but it does demonstrate how hard it can be on people. Based on my own experience, Marines and sailors spend weeks to months on a ship. Because of their actions when granted shore leave, we get the saying, spend like a drunken sailor. People are going to want to spend after being confined. Now, as a side note, if we have longer confinement periods, it would be good to have treats in your home. The mom and pop restaurants are some of the hardest hit. Many are offering online ordering with delivery. Not only would purchasing meals for delivery offer a needed treat for those confined, it would help many of the businesses and workers who are hardest hit. Please consider ordering out often. How worried should we be? This is clearly a very serious issue and threat. But while it's easy to feel this pandemic is much worse than other historic pandemics, it's really not. There have been worse pandemics. The macro model is based on information from 7 research papers on the effect of pandemics on the macroeconomy. It includes the Spanish influenza, which so far was the most severe and occurred during World War I. When the Spanish flu subsided in February 1919, the market began an increase of 50%, which lasted until November of 1919. Now, whether this increase occurred because of the end of the World War I or the end of the flu or both, it's impossible to say. But it does provide encouragement that once the coronavirus begins to subside, the market will bounce back once again. The R word. Recessions have historically been accompanied by large-scale reallocation of labor and other resources across sectors. The 2008 housing bust, for example, required massive reallocation of labor away from construction and real estate. It took years to regain employment. Likewise, the post-2000 tech crash required redirection of business investments away from IT equipment and software. This is not a business cycle downturn. It's an exogenous event. Unlike a business cycle downturn, current unemployed are likely to resume their former positions. However, airlines, restaurants, and cruise ships are unlikely to achieve this. It seems logical, though, that there would be no new need to restructure the overall economy as other business cycle downturns. Though behavior will change and some industries will never be the same. But there just is no need to restructure the economy. Confidence should quickly rebound once the event passes, simply due to the relief. Furthermore, the Fed is doing everything it can to stimulate the economy. The latest stimulus dwarfs the 2008 package. If this prolongs, it will only get bigger. But monetary and fiscal policy will not work at this very moment. It is like pushing on a string. The policies are designed to move economic activity forward, but the activity cannot move forward while it is being restricted. This will not always be the case. This will pass. This is not as severe as the 2008 financial crisis, at least as of today. And the stimulus is already much greater. So, as our conclusions, we depict grim scenarios in the term of fatalities. The US has recently surpassed 100 deaths, but the best case scenario assumes 30,000. The model predicts or depicts a sharp, temporary, and short-term shock to the economy with an impact of negative 1.5% GDP across the 3 scenarios, weighting the bull, the bear, and the base case, with a negligible 0.2% long-term impact to GDP. I want to point out the main driver for the model is the fatality rate and its effect on the supply and demand in the economy. Based on these numbers, a 15% drop in the market is a gross overreaction. As we all are aware, we are down much more than this. The bear case is down 35%, which is near where we are right now. It is important that I point out that this would require 100% certainty on the bear market. And in that case, you could justify the 35% down. This is not 100% certainty. Let's also look when your model is suggesting something that's so different than what you're seeing in the market, it's good to get additional confirmation. A basic PE analysis also indicates an oversold market. So there is confirmation. The current price to earnings ratio assumes zero earnings for companies for the next 2 years. Now, all of this said, this does not mean the market cannot go lower or that it's about to rally. The virus is not the only contagion. There is plenty of fear in the equity markets as well. It does mean, based on the current data, that we would add additional equity to portfolios on the downside, not at the moment. However, we are not just going to go ratchet up equity. We're going to continue to question our model, look for confirmation, and consider the correct course as the market gets cheaper. And this call has been very technical, and we decided not to cover the price of oil and the petrodollar. The swaps are horrendously difficult to understand. Interest rates now in the U.S. are near where they are the rest of the world. There shouldn't be any additional shocks from lowering interest rates. In addition, the price of oil should help the economy on the other side of this pandemic, though the U.S. producers struggle. To summarize, we continue to hold the view that this market is a buying opportunity, though we acknowledge how hard and painful it is to do so. But history and the data suggest this is the correct action. We also added gold to the portfolio. It is going down in value as everything else is, but it is holding up better than the market. Our portfolios are also holding up better than the market. We have a strong overweight to Amazon. While most of the market has been down today, Amazon actually ended up. We're seeing shifts in spending. Our technicals drove us to the technology sector, and most of the portfolios, whether mutual funds or in the wide moat strategy, hold a significant overweight to companies that will benefit or at least be shifted towards in this environment because of teleconferencing, home delivery, etc. We have maintained our spread over our strategy. Telling someone their portfolio is down if they were in all equity more than 20% is still painful, but we are holding up better than the relative market as well as the S&P. We also have full cash buckets based on not timing of the market, but just general planning principles. This is why it is so important to hold cash. And I want our clients and listeners to remember how difficult it was to hold cash last year when the market was up so much, but how good it looks to see that cash position at the moment. So I will turn this back over to John. And if you do have questions, we should have mentioned this at the beginning, please send those to your lead advisors and we will be answering those.
Thank you, Aaron. So we do have some questions actually, and one of the questions that we have is, should we move to cash, or should anyone move to cash at this point?
We do not think you should. Well, in the fixed income, we are moving to cash or cash-like bonds. If anyone is watching the movement in bonds because of how low the interest rate is, there's a lot of volatility there. So there will be cash-like investments from their bond positions just because of the risk. So the Barclays Ag, which is a very conservative bond portfolio, is down 3%, more than 3% today. So there will be cash-like products in your portfolio. Should you move to cash in your equities?
That's the bigger question.
That is a question. Our brains are saying just stop the bleeding. And by no means am I suggesting that we're at the bottom. It is very likely the way that this market is moving that we haven't seen the bottom. We hope we have, but no, we would still recommend against going to cash. As fast as this has gone down, and the amount of stimulus and other measures that are being put in place, this market can move very fast on the upside. And there is significant risk. We've been saying inflation for quite some time because we've used monetary policy and fiscal policy to deal with this. A lot of that has just been shuffling bonds held on a bank that really weren't in the economy for cash that never really made it out of the economy. We're talking about sending checks to people directly. Once again, this is not as far down as 2008, and the stimulus packages and measures and tools that are being used are they just dwarf the other side. So we would not move to cash. We would still stay equity. We're not buying aggressively by any means, but as we see these going down, especially based on the models that we see, the market seems significantly undervalued here. We would continue to over time average into those equity positions.
So we have a question. What events do you think will trigger a market recovery?
So that's a great question. When we're looking at the new cases, and there's a couple of websites that we could probably get out to clients if they are interested in watching this. A couple of countries that we've been watching: South Korea, they're the first ones to really have hit that inflection point where there are not many new cases. Iran has just crossed that threshold. China's been through that threshold for quite some time. They are trying to get orders filled. We've had reports that some factories are back to 90% capacity. That's not to say that there are not a lot of issues around that, because you got to be able to ship them to somebody, and that means they got to be ordering. But every indication is that once this passes, it could be very, very quick. And we've seen it, right? The market has been down 10%, 12%, which is historical. We've never seen volatility like this since people were meeting under button wood at 63 Wall Street. This is an anomaly, but it's just as quick on the upside.
Yeah. So one of the questions that came in is, are banks limiting withdrawals?
We've heard that they have been in some areas. So this is one of the things that we do counsel clients on, is holding physical gold and physical cash in safes in case they needed to get to cash because of a banking holiday. No matter how remote or how extreme that is, I think that the likeliness is there, and some banks are limiting the amount of cash to be withdrawn. It would be a short-term problem, right? Because the Federal Reserve and the U.S. Treasury, they have printing machines, and they can print up the cash and give it to the bank. It just takes some time to get it there.
Well, this is what we experienced in 2008, because we had money markets that were at risk of breaking the buck. So you would get back less than what you had in there because of that lack of liquidity.
But the money market is different than the banks. The money market is, and I know clients may or may not have picked up on it, it has been in the news a lot. That's the repo market. And that is actually where the Fed is injecting. And now, to give clients an idea of just how large this stimulus package is already is going to be if it doesn't get bigger. Over the last week, the Fed has injected more than $1.5 trillion into the repo markets. The TARP was $800 billion. And that's just going into the repo market. If we look at deficit spending, where there was a $1 trillion deficit spending in 2008, we're already seeing $2 trillion of deficit spending based on the current policies that are starting to make their way through Congress. And if this crisis continues to move on, and once again, the Fed and the government is pushing against the string, they're going to try to move that forward. So they're just going to continue to ratchet that up, though those policies are not going to take an effect until economic activity or those restrictions on movement are lifted.
So we actually have a comment from someone who is a president, CEO of a bank, who said that they're seeing that their customers have not been asking for significant withdrawals. But it's interesting that that could be a reaction in the next few weeks, just because
The rumors that I've heard, I think, have been mainly on the East Coast.
Yeah.
And there's still rumors.
Well,
there's a lot of rumors going on.
There's always rumors. So another question we have is, what are we doing for tax loss harvesting? Because certainly on the flip side of this are some positive things that we can do, because now we are able to go and position the portfolio so we can sell securities, realize losses, and replace them with the securities that we would expect to be the better ones to hold on the other side of this event.
Yes, we are not only taking advantage of doing tax loss harvesting in the taxable accounts to change some of our more defensive portfolios. That's one of the reasons tax loss or tax sensitive has held up so much better than the benchmark, is changes that we made in 2018 become more defensive. We held on to those because they were mainly small short-term gains. So now we're using this opportunity to make changes to that allocation, harvest the losses, get that tax asset, but we're also beginning to shift more and more towards U.S. large cap. Other economic regions seem to be hit much harder by this virus, and they already had demographics going against them. So we're using this as an opportunity to make changes to the strategic allocation and continue to favor U.S. domestic markets at this time.
So one of the things that you had mentioned is second wave. We don't really have any evidence yet. And I know that we have done some modeling on that. In fact, we had a conversation today with an executive of a large public company that does risk management. And that's one of the things that they're including in their models, because they want to understand what type of impact that would have on this large company should all of a sudden employees not be able to come in or lifestyles change. So can you comment on that, and what should we be looking for? How would we know that it was there? What would be the potential impact that they may have? I know it's a lot.
Yeah, there's a lot of questions. So what was the first one?
All right, so the first one, so we haven't experienced the second wave yet.
So the second wave, yeah. So there are a couple of so if we get a second wave, it could be for two reasons. Let's take China as an example. So they have slowed their cases. They are flat on the curve. They are not getting new cases at the moment, or the new cases that they're getting are still very, very small. It could be because they've reset and they're going to go through the whole process again, because just as much as the virus could not be contained in China and it made its way out despite all of the restrictions that they put in, that could resurge. The other option, and both of these could play out, is that the seasonality is accurate, that we do see a slowdown here in the northern hemisphere because of warmer weather. But then it moves to the southern hemisphere, and it would still be contagious. They would still see some new cases, but it wouldn't be growing at the level that we're growing. But then we get back to February, and then there would be a seasonality effect there, where fall, all of a sudden, it begins back up. So those are the two ways that we can have a second wave.
That's certainly one of the things about the second wave too. Let's say if it's in the fall or in February, is that we have moved to this rapid response vaccine determination process. And so there's certainly been a lot of movement, especially since when China had its first outbreak. I know that they put the virus on this worldwide database, and you've had scientists working on this for some time, and I'm sure that there's probably more developments here than what we even know. But what are your thoughts on that?
So let's say we do get the second wave. You would think after having several more months of this, and there's a lot of really smart people, a lot of drug companies that have every financial incentive to figure this out, we would be able to uh, better deal with the epidemic than we can right at this moment, because we still don't know the best treatments. I would think by February, if this virus is still running around the globe, we would have much better data, a much better medicine, possibly a vaccine to slow that second thing and be able to get that herd immunity. As I mentioned that earlier, you got to get about 60 to 70% of the population with antibodies before you can kind of stop the epidemic spread.
So let's get back to the empathy and emotion, because we had a couple of questions from our audience. One said, I can't stomach watching my account go down. I can't stomach watching my account go down either. But at least I know, as a sophisticated investor, these things happen, and you know, holy cow.
You don't have to be a sophisticated investor to feel this. We're feeling it. One of the things that we're trying to do in the investment committee is look at percentages instead of dollars, because these are big numbers. We're not only am I empathetic towards sympathetic, I'm feeling it too. It's hard. It is hard to get in there and deal with these emotions. We certainly feel the emotions in the investment committee, but we know that the process is the best way to deal with these. And our emotions, we have a fight to flight response, is to stop the bleeding. But if you look back over time, let's go back to 2008. The market was already off its highs significantly, as the S&P was still trading at 900 from its high of somewhere in the 15s. So much greater than we are now. And then people watched it go down all the way down to the 600, and I think 70 was a closing. I won't even talk about the intraday low, because it was such a bad number to use. But what was the right thing to do then?
To stay invested.
And
to buy more equity.
To buy more equity. Imagine if you could go back to the price whenever it's 900 before that 600 low, and that's the only thing you can do, is you can change your portfolio once and never again. No, the correct thing to do, looking backward, would be to change your account to all equities. And we're not advocating to do that by any means, because we're not looking backwards. But when we look at history, that is what would work pretty much every time. The one exception would be maybe Japan.
But we're not invested in one country.
We are not invested in one country.
Global economy, and there will be opportunities no matter what.
Nor are we going to take people that are in, let's say, a 60-40 and ramp them up to 100% just because we think the market's is significantly undervalued based on the data. One, maybe our data is not right and the market is right. You certainly have to respect the market. There are a lot of smart people that are looking at this data. So what we would do if we see more downside is to continue to look at the assumptions in our models to make sure that they're reasonable, get confirmation through other ways of valuing the market, and then continue slowly to add exposure to equity as we go through this, because we will eventually get past this.
We will get past this, and I know that the right thing to do is what we're doing, is easing into equities from fixed income.
But it's almost impossible to do in the moment.
It's almost impossible to do in the moment. That's why this whole concept of how do we manage our emotions and our philosophy on cash. You had talked about cash earlier. It's interesting looking back. You know, part of our process is that each quarter we look at our clients' cash targets and see where they are relative to the target. And in January, we're at a market high, and we refilled everybody's cash target, and we're now benefiting from the thing that we have always preached, is that you have to have cash, enough cash to make it through a bear market. Now, I don't know if we'll have a bear market, a recession, or whatever it is, but we're in a down market right now. We don't want to be in a position where anybody has to liquidate
Right.
because the values are down. So that's good for our emotions, knowing that we have that cash set aside. But there's still that emotion, should I go in? So we've been having queries from clients, should I be buying in? Should I be doing something different? How would you respond, and how would you deal with that from an emotional standpoint? Because people are saying, is this the right time?
Based on everything that we are putting together and modeling here, this market is significantly undervalued. So if we can just separate the pain of looking at where it is and the real possibility that it could go lower, based on the model, buying this market is buying it cheap. So our recommendation is to continue as best you can to put cash in when you have it. It doesn't really matter in the long term. Let's use that 2008. If you bought it 900, 700, whether it was before the bottom, after the bottom, you have fantastic returns if you did that. You have fantastic returns if you bought it 1,000 too.
Actually, that was one of the questions. It says, in the Great Recession, was it better to buy before or after the bottom of the market?
Well, it would be better if they rang a bell at the bottom and you could buy then.
We keep waiting for that bell, but we haven't had it
We
yet.
do. We've looked at pieces, and so out of the last recession, coming out of a bear market, the average compound rate of return was 18% over a 12-year time period. There's more money lost sitting on the sidelines than in the market over time. Yes, we come across these 20% corrections and get in these bear markets and below, or the average bear market is 35%. So we're just hitting the average.
Well,
on the other side, though, it's tremendous returns.
So let's think about that for a minute, because we're really in a different market right now. One of the things that we've been experiencing is extreme volatility up and down.
Yes.
So if we go back to 2008, and if you waited to buy after the bottom of the market, we didn't experience those significant ups in the way that we will likely see in this case, because of the amount of that fiscal stimulus. So maybe you can talk about all this fiscal and monetary stimulus that's going into the economy, and your analogy of the fire.
The fire.
The gas.
Oh, so yeah. So it's most of what we've reviewed before has been business cycle downturns, where the Fed is actually responding by monetary and fiscal policy. If clients are paying attention to the Fed announcements and what the market does the following day, when they cut interest rates 100 basis points down to zero, you would think that the market would have been on a tear. But it was down 12, 13% the following day. These things are just not working, and they're not going to work because the policies are designed to move economic activity forward, and they can't do. You can't do that if you are saying no one can do economic activity, or a large part of the economy cannot do economic activity. So that's what I was talking about pushing on the string. So if you want to get a bonfire started and you're going out and you need two things, fuel and a spark, and you pour a bunch of fuel on there and you stand back and you're waiting for the fire to happen, but there's no spark because you can't do the economic activity. And then you say, well, this must be really severe. We need to throw on more fuel. And they do so. And then once again, it sells further off, and they look to do it again and again, because the one thing they need to do to actually get this, the effect in the market that they're expecting, is to strike the match. And that match will be, they'll light it at some point. But if you have that much fuel, it's going to come back much, much faster.
Well, that's why it's almost too risky to wait then.
It is. So
And it's only because we don't really know how fast it's going to come back. But what we do know is that the circumstances are similar to the gas on the fire, because
let's just take our recent activity, right? We've seen more volatility here recently, both up and down, than ever before. We get more calls about, hey, should we just cut our losses here on the drops of -10%, -12, -13%, but the following day is up 10%. So let's say that we moved out on that 10% day. And I'm not saying that it can't be another 10% down, but then the following day is up 10%, pretty much recouping the losses from where you sold. And then it's up, we finally get through, it's up 5%, it's up 4%, and you're starting to feel good. You're like, okay, on this next pullback, I'm going to go in. Let's say it's up another 3%. We are probably already 20% off of the low. And what I'm not saying is that if you get out at the 10%, that there's not another 10% day. But even in that scenario, if you got out on the first 10% down, you're still 10% behind where you got out in that movement. And those are normal movements right now in this current market.
You know, I had a question here, which is kind of interesting. It says, should I max out my 401k now? And if the market continues to go down, have I made the right decision?
I believe you have made the right decision. Now, could there have been a better price point to get in? Certainly. I would, if we get a good recovery out of this by the end of the year, and a lot of the prognosticators out there that are reading the tea leaves suggest that we do get back to normal by the end of the year. It's likely that you're going to get a better price now than what will be the average price. Most people will buy in on their paychecks, so every month you're adding in. So you're probably going to get a better price than the average price that's remaining in the year if the market begins to rebound. Clearly, if you knew the bottom, and we're not going to call the bottom. This volatility is just way too difficult to call the bottom. You would be better off, but they don't ring a bell. I wish they did.
It would be nice. It would make our job a lot easier, but then
well, if we knew the bottom,
ring a bell, then everybody would be hearing
right.
it, right?
You would never have this volatility if you knew the highs and lows.
Now, another thing that had come up with discussion with clients this week is that the larger companies have a better cushion to survive these next 3, 4, 5, 6 weeks, where the small business owner really doesn't have that cushion, and they're going to be squeezed tightly on this.
Very much
so. Have a big fallout. So what's your opinion in terms of the impact that that's going to have?
I think our small businesses are the ones that are getting hit the hardest, for sure, and specifically those that are in the travel and leisure. That's why I think clients and just everyone, for their own personal reasons, if we're in confinement, but also just to help those mom and pop restaurants. The restaurants, as a small business, are on absolutely thin margins. They're not going to have cushions. And it could be a very old, very successful restaurant, and we could lose these jewels. St. Louis is known for its restaurants, right? It is, they are going to need a lot of support through this. The small companies, and specifically those that are going to be hit in the hardest areas. Thankfully, we have the internet. Not only is Amazon going to help us get through this, because now you can get deliveries at home. What would we do without that? Walmart's adapting. You'll have pickups, but so are these restaurants. They're being creative. One local restaurant here, through one of the celebrity chefs, Grace Meat and Three, they have put on an online order platform that you can order their food. It's comfort food, and instead of cutting their staff, they're not engaging the delivery driving companies like the Uber Eats. They're going to let their staff do all the deliveries. So they're just like every thing. Whenever we see changes in the economy, whether business cycle or other events that just change the way of behavior, there's creative people out there, and they're trying to figure out ways to keep those businesses afloat. But I do think it is good to be out there trying to help the ones that are going to be hit the hardest through this, because there are a lot of people that their livelihoods depend on this.
Well, my son's a waiter, and he texted me today saying that today's his last day because they're closing down all the restaurants. Mm-hmm. And I'm just thinking about how many people are going to be affected by this.
The airline industry also, their financials are never strong, and domestic travel could easily be cut off here anytime, and they're struggling through this as well. Now, they're not a small company, but there are a lot of people that are getting hit much harder than the overall economy. A lot of companies, because of the ability to teleconference and other things, they may not be running at full capacity, but they at least have good strategies to get through and weather this.
So I know we've run over our time here, so let me just summarize. First of all, thank you, Aaron. That was just spectacular. I know that you and the investment committee have spent countless hours working on the modeling, trying to understand exactly what the impact of the virus is, because I know we aren't experts at the virus, but we are experts at the market and trying to marry the two.
Well, it's fairly good at making models too.
Yeah, you are good at making models. I think that the important thing that we want to communicate to our clients is that this too shall pass. I mean, this is something that will pass. Now, will business be different? I think that what will happen is that we will have businesses will have to adapt to whatever the new life is like. This kind of reminds me of the 9/11 event. Do you remember everyone was glued to the TV and people weren't sure if they should go to work? And then we didn't have airplanes. People weren't flying. It was, and as a result, how has our life changed? You can't run to the airport last minute and jump on the airplane anymore. There's, all of the things that have happened because of the changes to protect ourselves. I think we're going to have something like that in business. I mean, it could be that by the end of this, people are going to get used to working from home or small communities. And so even commercial real estate may be struggling after this, because you have more people that will have virtual working instead of congregation.
There's going to be a lot of habits of people ordering on Amazon because they're used to it. There certainly will be a lot of changes. Another change that we're talking about in the investment committee, because we do have someone from China, is Americans tend not to, or people in the West tend not to want to wear masks. Well, there's a lot of people that would really like to wear masks if they could get a hold of them right now. So we're going to see a lot of changes off this. This is another one of those events that change the way people view the world.
Well,
but we adapt.
We adapt. And you know what? The markets are still the markets. People still buy goods. People still sell goods. Yes, they make goods. So the economic activity is going to continue. We will get past this. And I believe that our clients will be very well positioned on the other side. As hard as it is right now, as emotional as everybody feels, as scary as the next few weeks may seem as the virus starts to expand, I think that you guys have done a great job, and
we are looking at the numbers on expansion, and if we follow the same trend line as other countries, we should start to slow new cases on that growth rate in about 4 to 5 more days. Now, you won't notice it for another 5 days, but we're really watching that inflection point to see if it is contained here. That doesn't mean we're out of the woods on the second wave.
Right. So, well, thanks again, Aaron. Thank you to all of our audience, and we look forward to our next presentation, whenever that will be. And your lead advisors are always available. Oh, that's right. And tell me again.
So one of the things that we are trying to do is through these volatile markets So long as we have some bandwidth to prepare for these and pass that information on, we're trying to reach out to clients on a weekly basis so that they can continue to hear the updates on what we're seeing in the data.
Yes. Thank you very much. Good afternoon and have a good evening.